Hello, my name is Troy Adkins, and I am the founder and owner of Adkins Capital Management. I want to talk to you today about the key housing events that have transpired in the U.S. residential housing market during the second quarter of 2019. During the second quarter of this year, a review of the State of the Nation's Housing Report by the Joint Center for Housing Studies of Harvard University, an overview of housing litigation and policy issues, a Fannie Mae review of serious mortgage loan delinquencies, a Freddie Mac survey of 12-month primary mortgage interest rates, the actions of the Federal Reserve as part of its Federal Open Market Committee operations, and the U.S. economic forecast by the Federal Reserve Bank of St. Louis were the primary topics of discussion. This movie presentation also provides an overview of the home price level for a select group of cities that make up the Adkins 60 City Home Price Index, and it provides a wealth of information for prospective homebuyers to use in order to make a prudent home purchase decision. This presentation was written, narrated, edited, produced, and published by Troy Adkins. I am the founder and owner of Adkins Capital Management. Adkins Capital Management is a privately owned and independently operated company. Our exclusive focus is on residential real estate. Our company is not affiliated with any parties associated with the residential housing industry. Our mission is to bridge the gap in the residential housing market, where deficiencies in education, public policy, regulation, product structure, and personnel have created an environment where prospective homebuyers need objective information and useful analytical tools in order to help them make a prudent home purchase decision. As an investment professional, I have more than 15 years of real estate analysis experience, more than 10 years of institutional investment consulting experience, and more than 8 years of freelance financial writing experience. I am also the author of more than 25 published articles. For more information about my background, skills, and experience, please visit the Adkins Capital Management website. With this overview in mind, let me now turn your attention to the primary housing topics for the second quarter of 2019. During the second quarter of this year, the annual release of the State of the Nation's Housing Report by the Joint Center for Housing Studies of Harvard University provided a wealth of information pertaining to the U.S. residential housing environment. The general theme of the JCHS report is that household growth has finally returned to a more normal pace. In contrast, housing production has not. After falling for 12 consecutive years, the U.S. homeownership rate edged up in both 2017 and 2018 to 64.4%. The number of homeowner households was up by 1.6 million to a total of 78.2 million. The homeownership rate is roughly on par with the average rate in 1985 to 1995, a period before the latest housing boom and bust. Completions and placements totaled only 1.2 million units last year, the lowest annual production, excluding 2008 through 2018, going back to 1982. According to estimates made by the JCHS, annual construction should now be on the order of 1.5 million units. Although up 3.2% last year to 875,800 units, single-family housing starts remain below the 1 million mark for the 11th consecutive year. Builders and lenders alike are wary of speculative development that would expand the housing supply too rapidly. Nevertheless, the supply of more affordable housing will have to increase significantly in order to meet future demand. In 2018, sales of new single-family homes rose to 617,000 units. About 5.3 million existing homes were sold, down from 5.5 million in 2017. Sales of existing single-family homes fell by 3.1% to 4.7 million units. Sales of condos and co-ops dipped 2.9% to 601,000 units. The housing market cooled nationwide in late 2018, with evidence of weaker prices, sales, and construction volumes in metro areas across the country. The National Association of Realtors reported that the median sales price of existing single-family homes rose from $253,800 in 2017 to $261,600 in 2018 after adjusting for inflation. This increase outpaced growth in the median household income for the 7th straight year. Fueled by rapidly rising home prices and modest increases in mortgage debt, the aggregate value of home equity more than doubled between 2011 and 2018. The total value of home equity held by households has jumped from $7 trillion to $15.5 trillion since 2011 after adjusting for inflation. Home equity levels are approaching the pre-crisis peak of $17 trillion. And aggregate mortgage debt remains closer to the post-crisis low. The housing that is being built is intended primarily for the higher end of the market. The relative lack of smaller, more affordable new homes suggests that the rising cost of labor, land, and materials is making it unprofitable to build for the middle market. Prices for the lowest cost homes rose the fastest again last year. The median sales price for small homes was $197,000 in 2017, less than half the price for large homes. Despite increases in 2017, small homes under 1,800 square feet represented just 22% of single-family completions, down from 32% on average in 1999 through 2011. Completions of large homes with more than 3,000 square feet outnumbered those of small homes for the first time in 2013 and have continued to do so for 5 straight years. The limited supply of entry-level housing stock, coupled with a tightening and housing labor supply, could put home ownership out of reach for many more households, particularly if interest rates start to rise and credit lending standards are tightened. For example, with the economy near full employment, competition for workers has intensified, limiting the ability of the construction sector to ramp up quickly. On a 12-month rolling basis, the number of construction job openings topped 275,000 at the end of 2018, up 39% from a year earlier. The ratio of the median home price to median household income ratio rose sharply nationwide from a low of 3.3 in 2011 to 4.1 in 2018, just shy of the 4.7 peak in 2005. This ratio is a common yardstick for measuring affordability, indicating how difficult it is for would-be buyers to qualify for a mortgage and save for a down payment. However, prospective homebuyers need to understand that this ratio can be very misleading because it does not take into account the cost of debt for a mortgage loan. In a third of the top 100 metros, price-to-income ratios were even higher in 2018 than during the housing boom. More than 60% of home mortgages issued in the second half of 2018 involved down payments of less than 20%, and more than 40% entailed down payments of less than 10%. There has also been a significant increase in mortgage loans with debt-to-income ratios above 43%. According to a recent Urban Institute report, the share of Fannie Mae loans with such high DTI ratios more than doubled from 13% in 2013 to 29% in 2018. The share of Freddie Mac loans was up from 14% to 25%. The share of Federal Housing Administration loans was up from 42% to 55%, and the share of Veterans Administration loans was up from 33% to 46%. A 43% debt-to-income ratio is the cutoff percentage set by the Consumer Financial Protection Bureau for qualified mortgages. Qualified mortgages are loans that borrowers are more likely to be able to afford. The DTI limit does not apply to loans insured by the FHA, and under a temporary exemption to loans insured by Fannie Mae and Freddie Mac. Given the significant growth in mortgage loans exceeding the 43% limit, the expiration of the exemption in 2021 could result in a substantial shift in lending volumes from Fannie Mae and Freddie Mac to FHA. A shift in mortgage loans to FHA would result in a higher cost for borrowers or a sharp reduction in credit access for those with high debt-to-income ratios. Based on an assessment by Adkins Capital Management, a simple solution to address the housing burden would be for residential real estate developers to build residential high-rise buildings in order to minimize land acquisition costs, reduce building costs, and take advantage of economies of scale. During the month of June, the U.S. Supreme Court overturned a decades-old precedent by ruling that property owners shouldn't have to jump through state-level hoops before heading to federal court to stop the government from taking their property. Under a 1985 Supreme Court precedent known as Williamson County, landowners must bring claims against local governments in state court before they can proceed to federal court. But legal rules generally prevent federal courts from re-reviewing already litigated cases. Chief Justice Roberts wrote in the majority decision, "We now conclude that the state litigation requirement imposes an unjustifiable burden on takings plaintiffs, conflicts with the rest of our takings jurisprudence, and must be overruled." According to the Thomson Reuters Foundation, the Higher Ground Coalition of flood survivors, from states ranging from Florida to Missouri and Illinois, plans to bombard local, state, and national politicians with videos, photographs, emails, and postcards documenting flooding in order to shed light on the worsening impact that floods are having on victims. The push by local and regional leaders across 16 U.S. states suffering from worsening floods aims to halt development in low-lying floodplains and will strive to drive swifter action on climate change. According to a 2017 report by New York University's Furman Center, about 5% of the U.S. population in 2015 lived in areas expected to flood every 100 years. According to Fannie Mae, the single-family serious mortgage loan delinquency rate decreased to 0.7% during the quarter. Serious mortgage loan delinquencies refer to mortgage loans that are 3 monthly payments or more past due or in foreclosure. This is the lowest serious delinquency rate for Fannie Mae since July 2007. The Fannie Mae serious delinquency rate peaked in February 2010 at 5.59%. According to Freddie Mac, the 30-year fixed-rate mortgage averaged 3.73% during the month of June. The 15-year fixed-rate mortgage averaged 3.16%. This time last year, the 15-year fixed-rate mortgage came in at 4.04%. The 5-year Treasury indexed hybrid adjustable rate mortgage averaged 3.39%. This rate is much lower than the same time period in 2018 when it averaged 3.87%. For the second quarter of 2019, the national average mortgage loan interest rate for a 30-year fully amortized fixed-rate loan began the quarter at 4.11% and ended the quarter at 3.81%. In order to better assess the current mortgage loan interest rate environment, prospective homebuyers should remember that the national average mortgage loan interest rate for a 30-year fully amortized fixed-rate loan reached an all-time low of 3.31% in November of 2012, and it reached an all-time high of 18.63% in October of 1981. In view of realized and expected labor market conditions and inflation, the Federal Reserve elected to keep the range for the target federal funds rate at 2.25% and 2.5% during their Q2 2019 Federal Open Market Committee operations meeting. Ironically, the Federal Reserve's position to hold the target federal funds rate steady is a change in the Federal Reserve's monetary policy position, as the Fed raised the key target range interest rate level every quarter in 2018. Prospective homebuyers should closely follow the level of mortgage loan interest rates in their community, because a rising cost of debt will increase the amount of interest expense that prospective homebuyers will need to pay for their mortgage loan. This in turn will place downward pressure on the price level of residential housing in their community. As a benchmark proxy, prospective homebuyers should remember that a mortgage loan interest rate of 5.3040399% for a 30-year fixed-rate loan would require the homeowner to repay twice the home purchase price if the loan is repaid on schedule and held until maturity. The end of June edition of the Housing Market Perspectives by the Federal Reserve Bank of St. Louis provided important foresight into the state of the U.S. economy. Both new home sales and existing home sales have proved to be an early and reliable signal of housing downturns and, by extension, of possible economic downturns. In addition, single-family home sales are an ideal measure of regional housing conditions. Data on single-family home sales through May of 2019 confirm that housing markets in all regions of the country are weakening. Movements in mortgage rates, existing single-family home sales, inflation-adjusted house prices, and residential investments' contribution to economic growth all resemble patterns that preceded the last three recessions by about a year. The last three recessions started in 1990, 2001, and 2007. Through early 2019, these housing-related forecast indicators remain consistent with the possibility of a late 2019 or early 2020 recession. Now that I have provided an overview of the events and trends that have taken place in the residential housing environment for the quarter, let me turn your attention to the proprietary finance-based analytical methodology and cloud-based residential real estate analysis software application that you can use in order to provide an assessment of the price level of homes in your community. The Adkins Residential Home Valuation Analyzer is an internet-based software application that analyzes the relationship between the median home price level for a city and the median household income level for the city. With this information, the software application takes into account the most recent month-ending national average mortgage loan interest rate for a 30-year fully amortized fixed-rate mortgage loan and the assumption that no more than 28% of pre-tax household income should be spent by homeowners in order to repay the principal and interest costs for their mortgage loan. By utilizing this information, the Adkins Residential Home Valuation Analyzer can accurately assess the price level of homes in your city. From the first analytical perspective, the Adkins Residential Home Valuation Analyzer determines the level of underpricing or overpricing of homes in your city by calculating the mortgage loan interest rate that justifies the price level of homes in your city. With this information, the justified mortgage loan interest rate is compared against the national average mortgage loan interest rate in order to accurately assess the level of underpricing or overpricing of homes in your city. From the second analytical perspective, the Adkins Residential Home Valuation Analyzer calculates the percentage of household income that would have to be spent by the people that live in your city in order to justify the price level of homes in your city. With this information, the justified percentage of household income amount is compared against the traditionally accepted household income amount of 28% in order to accurately assess the level of underpricing or overpricing of homes in your city. By utilizing the Adkins Residential Home Valuation Analyzer, you can determine the level of underpricing or overpricing of homes in your community, as well as the magnitude of underpricing or overpricing of a specific home that you are considering to purchase. This in turn will help you make a prudent home purchase decision. For more information about our finance-based analytical methodology and the use of the Adkins Residential Home Valuation Analyzer, please review our finance-based analytical methodology report on the Adkins Capital Management website and watch the wealth of movie presentations that provide an overview of the Adkins Residential Home Valuation Analyzer. Moving away from these policy issues and events and to an assessment of the mortgage lending environment, it is important to note that for the second quarter of this year, 23 cities that make up the Adkins 60 City Home Price Index were classified as overpriced. Newark, Los Angeles, San Francisco, Honolulu, and Miami were identified as the 5 most overpriced cities in the index. In terms of a relative price level analysis, it is not possible to justify the home price level for the top 5 overpriced cities by reducing the 30-year fixed-rate mortgage loan interest rate from 3.81% to 0%. Therefore, in order to classify the homes in the top 5 overpriced cities as underpriced, it would need to be deemed prudent by prospective home buyers to spend more than the respective justified percentage of household income amounts. In order to justify the median home price level for each city, the median required household income level would need to increase to a level within the respective range of $60,168 and $214,354. Based on the median household income level, the quarter-ending national average mortgage loan interest rate, and the assumption that no more than 28% of pre-tax household income should be spent in order to repay the principal and interest costs of a mortgage loan, the justified home price level for the top 5 overpriced cities fell within the respective range of $155,737 and $519,795. Prospective home buyers should closely follow the level of mortgage loan interest rates in their community, because the rising cost of debt will increase the amount of interest expense that prospective home buyers will need to pay for their mortgage loan. This in turn will place downward pressure on the price level of residential housing in their community. On the other side of the spectrum, based upon the justified percentage of household income amount, 37 cities that make up the Adkins 60 City Home Price Index were classified as underpriced for the quarter. Oklahoma City, Wichita, Charlotte, Anchorage, and Little Rock were classified as the top 5 most underpriced cities in the index. Wichita, Charlotte, and Anchorage were classified as the second, third, and fourth most underpriced cities in the index based upon their higher justified mortgage loan interest rate amount. Little Rock was classified as the fifth most underpriced city in the index based upon its higher justified mortgage loan interest rate amount. In order to classify homes in the top 5 underpriced cities as overpriced, the national average mortgage loan interest rate would have to increase from 3.81% to more than the justified mortgage loan interest rate amount for each city, or it would have to be deemed imprudent by prospective homebuyers to spend as much as the justified percentage of household income amount in order to repay the costs of a mortgage loan. Prospective homebuyers should use the Adkins Residential Home Valuation Analyzer in order to assess the level of underpricing of homes in their community. Given the recent events that have transpired in the residential housing market, and taking into account the fact that buying a home will likely be the largest single financial transaction that prospective homebuyers will ever make, and the bulk of their net worth will likely be tied up in their home, prospective homebuyers should use the Adkins Residential Home Valuation Analyzer in order to analyze residential real estate from 5 financial perspectives. First, prospective homebuyers should use the Adkins Residential Home Valuation Analyzer in order to assess the level of underpricing or overpricing of homes in their community. Second, prospective homebuyers should use the Adkins Residential Home Valuation Analyzer in order to assess the largest amount of money they should spend in order to purchase a home. Third, prospective homebuyers should use the Adkins Residential Home Valuation Analyzer in order to assess the amount of money they would need to earn on an annual basis in order to be able to afford to purchase a specific home. Fourth, prospective homebuyers should use the Adkins Residential Home Valuation Analyzer in order to assess total home ownership costs expressed as a percentage of household income. And fifth, prospective homebuyers should use the Adkins Residential Home Valuation Analyzer in order to assess how much a home would need to appreciate in value each year in order to offset the costs associated with owning the home. By assessing residential real estate in this manner, prospective homebuyers will be able to make a prudent home purchase decision. For more information about the Adkins 60 City Home Price Index, to watch our catalog of residential housing movie presentations, or to subscribe to use the Adkins Residential Home Valuation Analyzer, please visit the Adkins Capital Management website at residentialrealestateanalysis.com. This is Troy Adkins, saying thank you for taking the time to listen to this presentation.